Hello and welcome to the fourth day of the ACT Annual Conference. I'm Sarah Boyce, and after some 20 years working in corporate treasury, I now provide policy and technical support here at the ACT. And today we're going to touch on the subject of LIBOR transition once again. I hope that I don't need to tell anyone that LIBOR transition is, to quote the US state authorities, a real and present danger. And we have heard a huge amount about LIBOR transition from the banks and the official sector in particular over the last few days. And I'm really delighted to welcome Tom Gilliam and Tim Woodthorpe from GSK, who are going to talk to us about putting in place revolving credit facilities using risk-free rates and giving us the corporate perspective. Before we get going, some housekeeping. Please submit your questions as we go along via the Q&A box, as we'll get to as many as we possibly can. As with all the other sessions at conference, this session is being recorded and will be available to watch on demand shortly after the session finishes. And also there is a virtual discussion forum which will allow you to share comments, ideas or takeaways about the session with speakers and fellow attendees. So the purpose of the next 45 minutes is really to give you an insight into the thinkings and approach that a major corporate has taken when it comes to addressing the challenges faced with LIBOR transitions. That's more than enough from me, so please, I'm going to hand over to Tim in the first instance, and perhaps Tim, you could kick us off by introducing yourself and then starting to talk about the journey that you took within GSK.
Of course, happy to, Sarah. Thank you very much for the introduction, and thank you to all of you for joining today. I'm Tim Woodthorpe. I head up the corporate finance team in GSK Treasury, reporting up to our group treasurer Sarah Jane Hall, who I think has been speaking elsewhere during the conference. I joined GSK about 10 years ago, but have been in Treasury for the last 3. Having spent some time in the tax team before that. So we've been invited here today because last month we successfully entered into some revolving credit facilities, moving straight to a risk-free rate as the basis for the interest rate. So skipping the whole transition stage and going straight from a LIBOR basis to a SONIA and SOFR basis, and we've been invited to come and talk to you about that and how we went about it. So hopefully that's the session you signed up for, because that's the session you're going to get. So it's day 4 of the Treasury Conference, and to liven things up, I thought I might open with potentially a slightly controversial statement, which is I think that as a class, corporates have been rather let down by the financial services sector on LIBOR transition. And the reason I say that is because there's a perception, I think, from banks and from regulators that it should be in the court of the corporates to drive the move to risk-free rates by asking our banks, asking our providers of finance to transition with us as we move towards risk-free rates. And my personal view is that that's actually getting things back to front, because what you're doing is you're putting the responsibility for the change in a different place from where the expertise is. Now, everybody on this call is involved in corporate treasury. It's our job to understand all these different rates, but our companies, with a couple of exceptions, are not financial services companies. I work for a healthcare company. We try to find drugs, we try to find vaccines, and it shouldn't be, in my view, down to GSK or any corporate to drive banks to make a change. When we enter into credit facilities, or indeed any facility, what we're looking to do is to add to our liquidity structure to manage our liquidity risk. We need to make sure that we understand what we're going to pay in order to get that extra comfort in our liquidity matrix. And we shouldn't really have to drive a conversation about the basis on which that payment is calculated. So what this should be really is a pretty short presentation where I say we went to our banks and said, we'd like to renew our credit facilities, please, as we do every year. And our banking group said, well, Tim, you may have heard LIBOR's going away. We've got these lovely new rates. Here's the terms we propose, which are market standard. And then we reviewed them and signed them. Unfortunately, it was slightly more complicated than that. So we will take you through sort of what we did in order to get to where we got to. So the first question, I think, given that nobody had really done this before, certainly not with the scale that GSK is seeking to enter into facilities onto, is why we decided to go first and why we decided to do it now. And as you can see, hopefully from the slide, I think we'd class ourselves as reluctant pioneers here. I never really like to do anything first. I think it's extra work, it's extra cost, it's extra hassle for something that, you know, should be a fairly set piece transaction. But we decided to go first anyway, and there were a few reasons for that. Firstly, you know, our facilities were up for renewal. It happens every 364 days, and we were aware that the September deadline before the pandemic had been relevant, and we suspected that with enough pushing, our banks could potentially be ready. We're on the first slide here at the moment, if you can flip on there. We suspected our banks should be ready if we asked nicely, and so the opportunity was there. We were also obviously able to stand on the shoulders of the excellent work done by other corporates earlier in the year in getting some transition language set up. Being that critical few months further on, we felt there was an opportunity for us to jump straight past that stage, but that couldn't have happened without the work that had gone before. Also looking ahead to 2021, we've got a pretty busy year planned. We've announced publicly our intention to separate out our consumer healthcare business into a freestanding company. That'll be happening on current timelines during 2022, and that means we've got an awful lot of work to do in 2021, including a lot of conversations with our banking group around a combined capital ask for those two businesses. And we were really keen to get as much as possible done this year in order to free up resource for next year. Also, I didn't really want to do a whole lot of work to put transitional language in this year and then have to take it all out again next year. That seemed to prolong the pain. So, and you know, the third point on the slide there, personally, I'm very pleased, and I know as a company we're very pleased that setting off on the path we did has been perceived as helpful to the market, and hopefully sets a path for other corporates. But if I'm totally honest with you, that was not our main motivation. Our main motivation was to get to where we knew we needed to get to eventually as quickly as we possibly could. So a question that I've been asked before is to what extent we had our board involved and to what extent we got sort of C-suite engagement on this. The honest answer is there was very little involvement and engagement. I think this goes back to my first point. From the perspective of the board, it, you know, the existence of the backstop revolving credit facilities is really a hygiene factor. They want to know they exist, and they want to know that the terms and conditions are appropriate and that we're not overpaying. But they're not actually terribly interested in the precise mechanism or drafting, and to be honest, nor should they be. So we do, as you would expect, need CFO approval to renew our facilities every year as part of our sort of standard policies and approvals processes. As part of that approval, we did inform the CFO that we decided we were going to try to push to move straight to risk-free rates. But a lot of that was really as a stakeholder management exercise, because we were slightly sensitive to the possibility that one or more of our banks might phone up the CFO and say, have you heard what ridiculous thing your treasury team are proposing? Could you please sort them out? And we were really keen to protect ourselves against that and know that he sort of stood behind us in what we were doing. We telegraphed it fairly clearly. In fact, when we renewed the facilities in September 2019, we actually said to the banking group then, we're entering into a facility that will mature after 2021. Can we do SONIA and SOFR, please? And they said, we're nowhere near ready. We said, well, fine. Come September 2020, this is what we want to do, and we're going to need you to do it for us. So we telegraphed the messaging very clearly throughout the year. So it wasn't a surprise to the CFO. He wanted to know whether the economics were unchanged. We said they would be, and he was happy for us to carry on. So I will hand over to my colleague Tom, who will introduce himself and then give an insight into how we kick the process off. Tom.
Thank you very much, Tim. Hi, everybody. I'm Tom Gilliam. I'm a Corporate Finance Director at GSK. And I've actually been representing GSK on the Bank of England's risk-free rate working group for a while. And so sort of fairly well plugged into the progress within that working group and the progress of the development of risk-free rates, which has certainly helped us a lot during the journey in terms of just the general understanding that we have within the company. So in terms of the journey that we went on, it is very important for us that we made sure we were very engaged with all of our banks through this process, because we know, particularly when we were starting these conversations, that this was early on in the pandemic. And so the concept or the topic of LIBOR reform would have been fallen off the radar for a little while. It's also very important for us to maintain a good relationship with all of our banks. We have 12 relationship banks, in itself a relatively small group for a company of GSK's size. And this helps us quite a lot in the process because we already have a very good, very close relationship with all of those banks. So what I did was kicked off, this is back in mid-May, I think it was this year, kicked off a process by setting up one-on-one calls with all of our banks to understand where each of the banks was in its process with regard to risk-free rates. So there's a few key questions, so understanding where the banks are in terms of being able to book these. It's been one of the key issues for a lot of banks is actually booking risk-free rate loans in their loan systems. So we wanted to have a conversation about that. We wanted to have a conversation about whether there's any differential in terms of how we should think about the various risk-free rates. So our long-term facility, it's a multi-currency facility, and back in May it was a dollars, sterling, and euro facility. So we wanted to have a conversation with the banks about where they were with SONIA, SOFR, and ESTA, respectively, being the risk-free rates for those three currencies. Now, it actually ended up being a really interesting selection of conversations because every bank was in a slightly different position. Some were super keen for us to make the move. They've been sort of wanting corporates to ask the question, wanting corporates to push this forward and show that there is demand. Some banks, I think, were, let's just say, comfortable doing it, but it wasn't really high on their radar. But they were still very comfortable and they could see the benefit of doing it. I'd say there were probably a couple of banks for whom it was a bit more of a struggle, and this was generally more of a systems issue, being perhaps a little bit behind the curve on the systems. But I think what I found really interesting is one of the main messages we had coming out consistently is almost every bank said, well, we can do it. We're ready to go. Of course we are. But I'm not sure about all of the others. So I think where we landed in our conversations internally is that, well, if all of our 12 banks are in that position, then we're good. And so off the back of those conversations, we were happy to then push ahead with the proposal to convert our facilities onto SONIA and SOFR basis. I think it's safe to say that in terms of SONIA, the banks were a lot more advanced, and this really comes back to what the point Tim raised earlier about the Bank of England's position was that all banks should be in a position to cease offering LIBOR-based products from the end of Q3. Now that was subsequently pushed back due to the pandemic, so I believe it's end of Q1 21 now. But having been working towards that initial date, our expectation was that all of the banks should be there or thereabouts to be able to book SONIA loans in September when we were executing this. With regard to SOFR, this is This was a little bit more difficult because you didn't have the same sort of hard deadline, I guess, that the banks were looking at. So there were plenty of banks who were comfortable doing it. A lot of banks actually were in a position where their systems were not going to be able to book SOFR-based loans, but they were quite happy for us to make an exception on that. Now, I think this is really just the benefit of being a company the size of GSK. If it's an individual one-off basis, it's possible to make these sort of exceptions, but it's not going to be possible on a grand scale. Now, hopefully the systems will be in place pretty soon to be able to do this. They certainly should be, but that was one of the key concerns that we saw. And on the third benchmark rate on ESTA, this one was quite interesting because the ESTA is much less developed as a benchmark rate. The market for ESTA-based products is also much less developed. And actually, some banks even had a very strong view that Euribor as a benchmark rate was going to remain relevant into the medium term at least, and hence that we should be sticking with Euribor. So I think I'll just go into a little bit more detail in terms of the systems point, because this seemed to be the biggest sticking point across a number of the banks. And did seem to be a little bit inconsistent. Whilst there seem to only be one or two core loan booking systems that are used by banks. I think there are fairly regular updates, and I'm definitely no expert in this, but it did seem that the banks were on different software versions almost of these loans. So some were pretty well set up to be able to book loans quite quickly, some a little bit further behind. And it's something that's definitely going in the right direction, but it's probably going to be a little while, I think, before they're all completely set up to be able to book, but hopefully not too long. I think for most banks, they were anticipating by the end of 2020 to be in a place to be able to book these loans. The last point I noted was around when we got to the stage of thinking about the process. We were very keen to be as pragmatic as possible in designing these facilities to make them as sort of user-friendly as possible, I guess, for all of our banks. In order to do that, we actually appointed a coordinator bank within our bank group to manage the comments coming back from other banks. Because in particular, things like the detailed position about how loans are going to be booked in systems, to be blunt, I don't really care on that one. I care that the banks are able to do it, but the precise details it doesn't really have any impact on me as a corporate. And so we felt it was much, much better for those sort of conversations to be managed bank to bank between people who are much greater experts at this than we are. And that way seemed to work extremely well, seemed to be very efficient, and certainly worked extremely well for us. So on that, I'll pass back to Tim.
Cool. Thank you, Tom. Sorry, I was spending a moment on mute just to make it feel like we really are in a virtual conference. It had to happen at least once.
Thanks for that.
So yeah, if you could stick us on one slide, that'd be great. Thank you. Brilliant. Thank you. So so yes, we were now ready to start engaging and start drafting, and again, a potentially heretical view, particularly heretical given that I qualified as a lawyer. I didn't really mind what the terms of the agreement were terribly much. I set two principles when I spoke to my lawyers. I said, firstly, I wanted the agreement to be consistent with the LMA principles and the recommendations of the various working groups, including the Bank of England, that we were part of. And I think that was really important because although, our main driver wasn't to help move the market along, we did feel a responsibility, having started down this path, to do so in as helpful a way as we possibly could. And Tom had played a role in those Bank of England working groups. We were very comfortable with the recommendations that were being made, and we were, very keen to follow those. The other principle really was to accommodate as many of the bank requests as we possibly could to allow them to accommodate these loans within their systems, picking up on the point that Tom made. So we struck a tone that was at the same time both uncompromising and unapologetically uncompromising in terms of wanting our banks to go on this journey with us, but also pragmatic. We knew that it was easier for some than for others, and we wanted to make sure that everybody could get there. And to be fair, all of the banks did get there. Some more smoothly than others, but they were all there. And I should say we are really very grateful indeed to our banking group for how hard they worked with their tech functions, systems people, compliance teams to get this over the line for us. Now, I actually found the drafting really interesting. As an individual and as a lawyer, some of it was fascinating stuff. I've never seen quite so many formulae in a legal document. But GSK's house view was we were agnostic, to be honest, about what it said. Tom will go into sort of some of the more interesting points that were debated on the final slide before we turn to questions. But yeah, it did really mean that we really relied on the lawyers to sort it out between themselves. So we used Sidley Austin. The banks used A&O. And we worked with HSBC as the sort of bank coordinator. So initially, GSK, Sidley, HSBC, and A&O, and they came up with a draft which HSBC believed should work for banks, which A&O and Sidley confirmed worked legally, and Sidley were able to advise us that we had maintained the commercial positions that we wanted to maintain, which was the comfort that we needed. And actually, once we rolled that out to the rest of the banking group, there were relatively few comments and questions, to be honest. I think people respected the fact that we were trying to do something as pragmatic as possible. The banks and their lawyers took only the points they needed to take. And actually, once we'd released that drafting for comment, it was a much smoother process than I think we had perhaps feared it was going to be. As we went along. I think part of the reason why we could be relatively relaxed about this was the way we view our backstop facilities. We view them as backstop facilities. Clearly they are facilities that we can draw on. That's the point of a committed facility. But like the majority of corporates, our intention is not to do so in the ordinary course. And so we felt there was limited impact on us practically from some of the more nuanced variances in the different calculation methodologies, and we just wanted to make sure there was something that worked. So Tom got to have a lot of the fun in debating the finer points of flaws and what have you, which he'll take you through on the final slide, and hopefully we'll have time at the end to open up the questions, and I'll remember to come off mute next time. Tom.
Thanks, Tim. Yeah, I feel now I should have put some of the mathematical formulae onto this final slide, and I feel much more comfortable with that, having a maths background rather than a legal background. So there's a couple of elements.
Sorry, I was just going to say, if you could actually explain the formulae simply and coherently to anybody, we could make a video just of that and put it up, to be honest, because nobody seems to be able to do that.
I don't know. I think that's a bit too niche, Sarah.
You'd be amazed. Sorry, Tom, I interrupted.
No problem at all. So just a couple of sort of specific considerations that I thought I'd go into here around the facilities. The first one relates to the spread adjustment. So this is the spread between LIBOR and the associated risk-free rate, and how that is calculated. So as Tim mentioned earlier, one of the principles we wanted for these facilities was that for them economically to be as close as possible as like for like to our existing facilities. And the way to achieve that was to calculate an appropriate spread to put into the agreement such that the SONIA plus adjustment spread plus credit spread was broadly equivalent to the LIBOR plus credit spread that we had in the previous facilities. So the way this was calculated was based off a 5-year historical average of that spread, which I believe is the market standard approach. And one sort of small nuance in here is that actually what we did is we calculated what that spread was around about a week before we signed the facilities. So whilst technically not exactly correct at the point of signing, it just operationally made the process much simpler to agree a number that could then be put into all the drafts pre-agreed before execution. And the impact of 1 week over a 5-year average period is negligible, really, in terms of the impact of it. So that was how we thought about the spread adjustment. One of the other quite interesting areas was the calculation around the 0% floor. So this, we were trying, on the same principles here, we were trying to replicate the 0% LIBOR floor as part of the risk-free rate calculations. And the way that's done is by adjusting the adjustment spread if those risk-free rates are below 0. So again, a little bit of sort of technical maths, but I guess the principle of it is coming back to the same thing of trying to make sure the actual sort of economic commercial terms of the agreement are on a consistent basis with how they were originally. One of the other big changes we made to facilities was that we actually took euros out of our long-term facilities. So took out the ability to draw euros. So this, if we were regularly drawing on these facilities, then that would have an impact on the company. It would reduce our flexibility. You could argue about sort of pricing differential between the different markets as well. So there would have been some value loss there. However, as Tim mentioned earlier, the way that we think about our facilities is as genuine backstop facilities. So we wouldn't anticipate to be drawing on them as part of our normal course of business. And the way GSK operates, so GSK is a sterling-based company. We maintain our liquidity in sterling. We raise most of our short-term funding in the USCP market. So if we were ever to have a need to draw on the facilities, it would almost certainly be in sterling or dollars. And given those facts together, we were quite comfortable that we were happy to take euros out of the facility without it having any sort of material impact or any impact really at all on the company. In terms of the drafting, the reason for this was that none of the banks were comfortable using ESTA as a reference rate in facilities because of what I mentioned earlier about sort of how underdeveloped ESTA is. And we didn't want to have a facility that was referencing daily risk-free rates for 2 of the currencies, but referencing Euribor for the 3rd one, because that would have presented too much drafting complication and too much recipe for confusion, really, in the agreements. The 3rd point here was actually around our systems, so our internal TMS capabilities for booking these loans. We've actually been going through a process recently of putting in place a new TMS, which is always an exciting journey. But luckily, at the new TMS we put in place, we're comfortable that we are able to book loans on a risk-free rate basis within it. One point to note in there is that the system does not yet have the capability for pricing risk-free rate-based swaps. So if we were to be entering into interest rate swaps over the top of the facilities, that would be something we'd need to be doing manually. But that's not something that we would ever expect to do, because I think if we were in a position where we were likely to be drawing on the facilities, it would almost certainly be on a very short-term basis, and so it's not something we'd ever look to swap. And so hence, sort of all of that together means that we were quite comfortable that we were able to book and manage these positions ourselves. And with that, Sarah, I think I can pass back to you, and you can have a look at any questions that have come in.
Okay, no, that's really helpful and very, very interesting. Thank you both very much indeed. I think that it might be quite interesting just to start. I have many questions actually on the basis of what you've just been talking about, but just while it strikes me, so this backstop facility, you now have that in place. How often do you renew that facility? Is that something you do annually, or?
Yeah, we have two
Yeah.
facilities. As you would expect, they're all disclosed in our annual report, so I'm not giving anything away. We have a 364 day, and we have a sort of longer term 3-year facility. So we do come to renew that on an annual basis, and the approach we generally take is just to renew them both to maintain the duration of them.
Yeah, literally just have them there as the buck stops. Yeah.
Which is why I refer. Sorry, Sarah. Which is why I refer to this as to some extent a hygiene factor for us. It's an annual process which doesn't normally get the full attention of senior management, other than to understand that it's going ahead, and that's why obviously we were keen to sort of get through the pain point of the move to risk-free rates as quickly as we possibly could.
Yeah. And having done it for the backstop, do you anticipate doing all of your transactions on RFRs going forwards, or do you think that over the next few months there may still be some LIBOR activity going on? Without giving too much away, obviously, but just as a general direction of travel. Is this the new normal, I guess, is the question.
I mean, we don't have a very large portfolio of long dated swaps, so it's not really a live question for us. Clearly, as we come to execute anything new, we'll look at what we should do in the circumstances at the time. But the other area where we have thought about this, obviously, is like a lot of corporates, we come to various funding windows and decide whether or not we want to be issuing a bond, and we have previously thought, well, would a floating rate bond meet our needs at this time? And it's been clear that actually the market is not necessarily ready with the same depth and pricing tension to have a SOFR or SONIA linked bond as they are LIBOR, which again goes back to my sort of original point. I don't understand why they're not, because it's anecdotally, this is 12 months out of date, but anecdotally, when I asked the question of my banks, they said, well, a lot of investors can't book it on their systems yet. And I don't understand how really grown-up investors find themselves unable to invest in a product which a corporate might wish to issue, and which will be outstanding post-LIBOR transition. So we've not had to consider the position in anger, but I'm very comfortable letting somebody else be a pioneer next time around.
And just as an aside on that, actually, there is a session with an investor on LIBOR transition somewhere in the Watch Again area on demand, which might be interesting for those of you who are trying to get to the bottom of exactly that challenge. But Tim, you're exactly right. I have heard exactly the same challenge, that booking the trade is beyond them at the moment, and therefore certainly not something that they'd want to do in any scale. And talking about booking the scales, I know that you mentioned about you've got a very select relationship bank group, and they all came along on board. Did you ever at any point feel, and I don't want names or anything, but did you feel that some were really, really going to struggle to get there, or was it most of them sort of huffed and puffed a bit, but could get across the line? I can remember from my Cadbury days, every now and then you'd suddenly think, I'm really not convinced that they're going to be able to do this.
I think the important thing is that they all got there,
and
some of them were more open than others about how easy or difficult they were finding it. Others maybe they found it harder than they let on, but the fact is they did all get there, and from my perspective, some were smoother than others, but I don't actually know what was happening bank side with everybody. But no, they did all get there, and I think, as I said, we are. I've been slightly dismissive of the of the financial services sector at the beginning of the talk, but we are very grateful that they did all they did all get there. It does, I think, go back to a point Tom made about the advantages we had being a company of the size that we are. Because a question that I sort of been asked on this is, if others want to follow down the same path, what advice would you give them? And I think there are two bits of advice. One is engage with your banking group early, and the second one is start from the position of being a FTSE 20 company, because it makes it all much easier.
I can certainly agree with the second point. I can remember back in the day, it makes life a lot more straightforward if you've got big feet. Anyway, so going back to GSK a little bit, and maybe a little bit more about what's next for LIBOR transition and GSK. One of the challenges for a lot of corporates is less to do with the financial market stuff and to do with more commercial contracts or intercompany funding. I don't know if one of you have any thoughts about what's happening, what your plans are, particularly with intercompany, perhaps?
Yeah, very happy to pick this one up. And you're quite right. This is going to be a really big topic for us. It's a little bit less urgent because we have control, if you're looking at intercompany agreements, over both of the parties involved. So the paperwork part of it, we have a fair bit of time to agree, and this is something that I've been working quite closely with our tax team on, actually, about sort of working out how best to be drafting up all of this. One of the major concerns they have is actually, because doing this by definition will be opening up our intercompany loan agreements, and that in itself may trigger conversations with tax authorities around the world to agree those intercompany loan agreements and agree that they sort of meet the relevant regulations. So I think it's likely to end up being a very big piece of work, this, because it's not as simple as just redrafting a load of documents, signing them, and that's it. We're done with it. There's a lot more to it. So yeah, I think this is one that's likely to keep me and the tax team busy for a little while as we go through next year.
Well, with everything else going on at GSK, I'd hate for you to be bored. So, a question's just come in. Just one moment. I'm going to have to read this. It's a very long question. Just one moment, chaps. No, don't worry. It's a very technical question, actually, and I suspect that what I'll do, Tom, is I will forward it to you and ask perhaps you could just answer it directly. It's to do with lag and delayed payments. So I think in the interest of time and avoiding too many equations in this conversation, I'll just back that to you to reply directly, if that's okay.
That's no problem at all.
Tim, thank you. Tim, you said that if there was to be any advice, it would be a FTSE 20 and start talking to your banks early. Tom, have you got any pieces of advice that you would particularly like to add to those two little gems?
I mean, those really are the two major points, and in particular the point about talking to banks, because obviously the second point, you can't really do too much about that. But do just have the conversation. I mean, it's something that I found fascinating in all of the conversations I had, was how every bank was in a slightly different place. And whilst they're all going in the same direction, for some, the timetables they were looking at were really quite different. So do start having the conversation and do sort of try to warm your banks up now to the idea, because it's something that's going to need to happen. I would hope there will also be a push from the bank side to be converting facilities as soon as possible, because it's not that long before we get to the end of 21, so the anticipated time when LIBOR will cease to be published. So it's definitely going to become a major topic and become very live over the course of the next probably 6 to 9 months, I would have thought. But yeah, just keep the conversation going.
Okay. No, I think that's really helpful, and particularly as you say, when we come to active transition and perhaps some of the more tough legacy transactions that some organisations may well have somewhere lying around on their books. It's going to be an interesting 2021, even without all of the work that you guys are going to need to be doing for GSK itself. Okay, so in the interest of time, we've pretty much come to the end. So I'd like to thank you both very, very much indeed for taking us through the experience that you've had at GSK. It's absolutely invaluable for us to be able to hear about real life experiences, and particularly, as you said, Tim, because there is a bit of a, if I put this politely, a bit of a disconnect perhaps between the expectations of the regulator, the banks, and the corporates as to exactly who should be taking the lead on these things. So I would, as Tim and Tom have both said, please do go and talk to your banks, to your stakeholders, and think about developing a plan about how you're going to transition as much as possible between now and well in advance of the end of 2021. You really don't want to be trying to work through transactions in this time next year, November, December of next year. It's going to be very, very uncomfortable. A reminder that there's a whole raft of information available on the ACT website, which will also link you to the FCA, Bank of England, and various working group sites. And please also do go to the exhibition hall and have a chat with both bankers and TMS providers to see how they can help you. To Tom's point, the sooner you start those conversations, probably the easier life is, or more straightforward life hopefully is going to be. And you can also post questions directly to the speakers today by messaging them within the conference app. Please take the time to fill in the feedback survey. This is very helpful when we're arranging events. And also take a look at the agenda for the rest of the conference. I know that we're in the final afternoon, and the session after this is a final keynote from a futurist who they're normally very interesting to listen to. But there are many other sessions on LIBOR that have been recorded through the last few days. And an upside of the virtual conferences is that all of the sessions are available on demand. So please do have a look through and watch on catch up. I think that pretty much wraps us up. So I would like to say thank you very much indeed to Tim and Tom for your time today. Thank you and goodbye.
Thank you very much.